This one's a little different though. I'm not here to report on XYZ, pick your favorite company, retail outlet going out of business. This is a general statement from the Economic Collapse blog.com. Why America's retail apocalypse could accelerate even more in 2018. Of course, Sears down, Sears Canada, another 60 stores down, and my goodness. Is the retail apocalypse in the U.S., and remember, the forecast that 2017 would break all records has already come true. It's already a done deal. The numbers are in. I told you this a few days ago. We still got 2 months left, roughly. Well, at the time we did. Now we got about a month and a half left. So we've already shattered the record, just as an FYI. But what he's saying is it going to even be worse in 2018? And while we understand, look, we know there's the Amazons and the online stuff, but is that really going to cause the type of carnage we've seen in 2017? All in one fell swoop. You know what I mean? Like, I don't know about that. Is the retail apocalypse in the U.S. about to go to a whole new level? That is a frightening thing to consider, because the truth is that things are already quite bad. We have already shattered the all-time record for store closings in a single year, and we still have the rest of November and December to go. Unfortunately, it truly does appear that things will get even worse in 2018 because a tremendous amount of high-yield retail debt is coming due next year. In fact, Bloomberg is reporting that the amount of high-yield retail debt that will mature next year is approximately 19 times, yes, that's 19 times larger than the amount that matured this year. Oh, please. Just $100 million of high-yield retail borrowings were set to mature this year, but that will increase to $1.9 billion in 2018, according to Fitch Ratings, Inc. And from 2019 to 25, it will balloon to an annual average of almost $5 billion. Oh, no problem. We got that in our back pockets. These stores are already collapsing now. Bankruptcy for Chapter 11. Oh my gosh. And you're telling me those are the numbers over the coming years? The amount of retail debt considered risky is also rising. Let me rephrase that. The amount of retail debt considered risky? No, all of it. It's all risky, and it always was. No, this is AAA stuff. A couple years ago, this was all AAA, good stuff. No. It was never AAA. You only thought it was, because so-called Fitch and Friends rating agency told you it was. The same ones that told you the mortgage-backed security garbage that led to the 2008 crash in our economy was AAA rated. And they put the worst assets, so to speak, mortgages in there in these pools so that they can just, oh, this is AAA. No, you've got a couple of cherries on top and a stinking pile of horse manure underneath it. Fitch Ratings says it's AAA, baby. Over the past year, high-yield bonds outstanding gained 20% to $35 billion, and the industry's leveraged loans are up 15% to $152 billion, according to Bloomberg data. Even worse, this will hit as a record $1 trillion in high-yield debt for all industries comes due over the next 5 years, according to Moody's. You know, Moody's and Fitch, you know, same kind of thing. Can you say debt bomb? For those of you that are not familiar with these concepts, high-yield debt is considered to be the riskiest form of debt. Retailers all over the nation went on a tremendous debt binge for years, and many of those loans never should have been made. Now that debt is going to start to come due, and many of these retailers simply will not be able to pay. So how does that concern the rest of us? Well, just like with the subprime mortgage meltdown, the spillover could potentially be enormous. Here's something else from Bloomberg. The debt coming due, along with America's overstored suburbs and the continued gains of online shopping, has all the makings of a disaster. The spillover will likely flow far and wide across the U.S. economy. There will be displaced low-income workers, shrinking local tax bases, and investor losses on stocks, bonds, and real estate. If today is considered a retail apocalypse, then what's coming next could truly be scary. Now, what I just quoted you was from Bloomberg. Okay? And then he goes on to say, I have written extensively about Sears and other troubled retailers that definitely appear to be headed for zero, but one major retailer that is flying below the radar a little bit that you should keep an eye on is also now Target. Target has a target on its back. For over a year, conservatives have been boycotting the retailer, and this boycott is really starting to take its toll. Remember the whole transgender crap bathroom? Boy, the people did not like the CEO of Target's stance on that, and boy, did they let him know. $1 billion in losses. And they go on to say, excuse me, they go on to say, Target has been desperately grasping at ideas to recover lost business, including remodeling existing stores and opening smaller stores, lowering prices, hiring more holiday staff, and introducing a new home line from Chip and Joanna Gaines. But Target stock remains relatively stagnant, opening at $61.50 today, $61.50, of course. Certainly nowhere near the mid-80s as of what it was in April 2016 when the AFA boycott began. In the past, retailers could always count on the middle class to bail them out, but the middle class is steadily shrinking these days. In fact, at this point, 1 out of every 5 U.S. households has a net worth of... Go ahead, I want you to guess. I want you to guess. Think a number in your head. Got it? 0 or less. How the F do you have less than 0? Oh, that's because you're massively in debt. You owe more. Oh, okay. And we must also keep in mind that we do not actually deserve the debt-fueled standard of living that we currently are enjoying. We are consuming far more wealth than we are producing, and the only way we are able to do that is by going to unprecedented amounts of debt. The following comes from Egon von Greiser. This is a guy I haven't quoted in a while, by the way, but he's a sharp dude. Total U.S. debt in 1913 was $39 billion. Today it's $70 trillion, up 1,800 times. But that only tells part of the story. There were virtually no unfunded liabilities in 1913. Today, they are $130 trillion, those unfunded liabilities. So adding the $70 trillion debt to the unfunded liabilities gives you a total of about $200 trillion. In 1913, U.S. debt to GDP was 150%. Today, including unfunded liabilities, the figure becomes almost 1,000%. This is the burden that ordinary Americans are responsible for, a burden that will break the U.S. people and the U.S. economy, as well as the dollar. The only possible way that the game can go on is to continue to grow our debt much faster than the overall economy is growing. Of course, that is completely unsustainable, and when this debt bubble finally bursts, everything is going to collapse. We don't know exactly when the next great financial crisis is coming, but we do know that conditions are absolutely perfect for one to erupt. According to John Hussman, it wouldn't be a surprise at all to see stock prices fall more than 60% from current levels. And he says, at the root of Hussman's pessimistic market view are stock valuations that look historically stretched by a handful of measures. According to his preferred valuation metric, the ratio of non-financial market cap to corporate gross value added market cap / GVA. Stocks are more expensive than they were in 1929 and 2000, periods that immediately preceded major market sell-offs. U.S. equity market valuations at the most offensive levels in history, he wrote in his November monthly note. We expect that more extreme valuations will only be met with more severe losses. Those losses won't just include the 63% plunge referenced above. It'll also be accompanied by a longer 10 to 12 year period over which the S&P 500 will fall, says Hussman. Now, again, I gotta say, Janet Yellen, we don't see another market crash in our lifetimes. Is it possible? And remember, Trump wants to come in. I want to make America great again, yada, 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 right? He's draining the swamp in Saudi Arabia. He's playing a game with the Democrats and the Bushies, all these people. You know, with all these investigations to Russia, which have now led right to uranium run. They weren't expecting that, right? He played them like a fiddle. Yeah, like a freaking fiddle. I'm just going to say, is it possible? Trump, of course, agrees. Federal Reserve, do whatever you need to do to keep this whole Ponzi system propped up. You need to add more to your balance sheet, go for it. But don't issue any debt like treasuries. We're not going to issue treasuries on that. Just buy it up. Print the money, put it on your balance sheet, buy it up. So we don't have to pay any interest on that. And while you're at it, of course, keep the stock market going high, which would mean what to the average American who has some kind of stock market investment, 401k, etc. What that would mean is you're going to continue building that nest egg year after year after year, and it's going to look nice. Because if you see the market going up the way it is now, every year, you're going to be ecstatic when it's time for you to retire. So the question is, are they going to be able to keep it going for that damn long? Trump certainly wants to, I can tell you that much. And if all the Federal Reserve has to do is print money and do it without adding to the debt, or even if it is added to the debt, it's not that we have to pay the interest to some foreigners or whatever, like on treasuries. You know, which would be an interesting thing to see how they handle that. But believe me, I've done my fair share of videos about, hey, the stock market, we haven't seen these kind of numbers since 1987 crash, since the 2000 crash, since the 2008 crash, and then nothing happens, and then nothing happens, and the markets hit all-time highs, and they keep going higher. This is funny because Lindsey Williams did say that, and I told you what he said, like, I can't buy this, come on. It's not exactly a melt up, but at the same time, is that what you'd expect to see? A massive increase of epic proportions month after month, or just a nice steady inclination, a little bit higher, a little bit higher, a little bit higher, right? You talk about people's retirement and stuff. They're not going to get crypto returns. The Fed is not going to make the Dow Jones and S&P return. You know, you just flipped it 6-7 times your money, or it's up 20% today, it's down. It's up 40% today, it's back down. You know, that's not happening. So you're going to have to settle for a little percent or two here and there. And then by the time you're at the end of the year, you have a nice little percentage. Oh, it's up 8% this year. Wow, nice. That kind of a thing. So just something to think about is all. Something to think about. Having said that, that's not going to save the retail apocalypse, right? Because they don't get a bailout. They don't have the Federal Reserve in there buying up all their shares. Not going to happen. Take care.